Welcome to the China Memo. We make unbiased observations on structural trends. I'm your host, born in China, trained in Western finance. In the year 2000, roughly 1.2 billion people in China lived below what the economists called the consuming class threshold, about $11 a day in purchasing power. By 2030, roughly the same number of people are expected to sit within or above that band. The same number, different lives entirely. This represents the largest migration into the global consuming class ever recorded. It happened in 2 generations, and it is still unfolding. At the same moment that hundreds of millions of Chinese households are reaching the threshold, where spending beyond survival becomes possible, surveys show that 80% of consumers say they are actively choosing cheaper products than before. Saving rates are up, households are repairing balance sheets, not upgrading them. The phrase on everyone's lips in Chinese media right now is called 消费降级, consumption downgrade. So which story is true? The great consumer rise or the great consumer retreat? Or both? And understanding how you get to both simultaneously in the same country at the same moment is what this episode is about. Today, I want to take a deeper dive than usual, not just the last 2 years of caution and trade-down behavior, but the full 50-year arc. From Russian coupons and scarcity through the appliance boom and the property decade, through Guochao and the national brand pride, and into today's phase of value-seeking, deleveraging, and what Chinese researchers are calling the third consumption era. This is a structural diagnostic. Let's look at the data. Let me start at the beginning of this arc, because the context matters more here than in almost any other China story. Before reform and opening in 1978, most urban and rural households in China lived inside what Chinese scholars called 短缺经济, a shortage economy. In other words, not enough of almost everything. People queued with Russian coupons. Government-issued tickets that entitled you to a fixed quantity of food, clothes, coal, cooking oil, and so on. Purchasing decisions were not about preference. They were about availability. Think of it less like a consumer market and more like a rationing system with Chinese characteristics. The question was not which brand. It was, is there any? As income levels began rising through the 1980s and the 1990s, that calculus shifted, slowly at first, then with gathering speed. Families upgraded necessities in sequence: clothing, a bicycle, a fan, a black and white television, then a color one, a refrigerator. These were not luxury purchases. These were the first rung of a ladder that hundreds of millions of households were climbing simultaneously. The McKinsey analysis that maps this onto the consuming class threshold captures the scale cleanly. At the turn of the century, around 1.2 billion Chinese were still below $11 a day in real purchasing power. The consuming class, people with enough income to make genuine discretionary choices, was a thin layer at the top of the income distribution. What happened over the following 2 decades is not easily described, without reaching for superlatives that feel inadequate. Within 2 generations, hundreds of millions of people moved from survival spending into a position where choice became possible. That transition is the foundation for every consumer story that follows. Chinese researchers and economists have developed their own framework for mapping this revolution, and I think it's more useful than the Western categories. So let me walk through it. They describe 3 broad consumption eras, each defined by a different question the consumer is asking. The first era is the scarcity to sufficiency phrase. The question is simply, do I have enough? Food, clothing, basic durable goods. This maps onto the pre-reform period and the early reform years. The economy in Chinese shorthand shifts from 短缺经济 to 过剩经济, which means from shortage economy to surplus economy, from not enough to more than enough. That transition alone took roughly 2 decades. The second era is the appliance and upgrade. The question becomes, do I have the right things? Owning the household 三大件, the 3 big pieces, television, refrigerator, and washing machine, became the marker of having arrived in the middle class. Then came cars, then home renovation, then the first wave of what economists call consumption upgrade, trading up from functional to aspirational. This is the era that built the property boom, the car market, and the domestic appliance industry, and the first wave of Chinese middle-class identity. The third era, where China sits now, unevenly and incompletely, is described in Chinese research as 个性化差异化需求日益增长, which means personalized and differentiated demand keeps growing. Consumers are no longer satisfied with one-size-fits-all products. They look for niche offerings, emotional or spiritual value, quality, and strong value for money. In plain language, the question has shifted from, do I have enough, to, does this fit me, feel right, and offer good value? That third question sounds simple, but it represents a profound change in what brands, products, and marketing have to do to earn a purchase. And it is the question that is reshaping Chinese consumption right now, filtered, as we'll see, through a significant layer of financial caution. Now, let me layer in generations, because age shapes everything in this story. People born in the 1960s and early 1970s carry lived memory of the shortage economy. They remember ration coupons. They watched their parents navigate scarcity. That experience tends to produce a durable conservatism around spending. Prioritize security, invest in children's education, keep reserves. Even as income levels rose, this cohort often remained more frugal than their income level alone would predict. Those born in the 1980s grew up as reform accelerated and the markets reopened. They are the generation that drove the first wave of genuine consumption upgrade. Better housing, cars, overseas travel, private tutoring for children, gym memberships. They began to spend not just on function, but on reducing stress, and, as Chinese commentary puts it, 享受生活, enjoying life. They're also the generation that bought the most property, often at peak prices, and is now living with that decision. The 1990s and 2000s cohorts shifted the register again. This is China's first truly digital native generation. They grew up with smartphones, short videos, e-commerce, and a vastly wider awareness of global aesthetics and subcultures. They look for personalized consumption, niche brands, craft coffee, independent fashion, experiences that feel authentic rather than mass-produced. Brand loyalty is thin. Reviews and peer recommendations matter more than advertising. But here is the twist in the current moment. Even this expressive, experience-oriented generation is now operating inside a value for money frame. They still care about self-expression, health, and authenticity. They still want good vibes, but they check the price-performance ratio carefully. They compare, they wait for promotions, they use platforms specifically designed to service the cheapest option for any given product. The desire for meaning in consumption has not disappeared. It has been filtered through a tighter economic lens. That combination, identity plus value, is what's driving the most interesting brand dynamics in China right now. Before we get to the property shock and the current phase of caution, I want to spend a moment on digitalization, because this is the infrastructure through which all of this plays out. McKinsey estimates that millennials and Gen Z, those born between 1980 and 2012, already account for more than a third of Asia's consumption, rising toward 40% by 2030. In China, this demographic is not just mobile first in the sense that they own smartphones. They live on their phones. One survey reports that 29% of Gen Z spend more than 6 hours a day on their devices, most of it on short video. Think about what that means for how a purchase happens. Product discovery via a 30-second clip from someone who looks like you. Social proof assembled in real time through comments and share accounts. One tap to buy, delivered the next day. The friction between seeing something and owning it has been compressed almost to zero. Live streaming has become a primary sales channel, not a novelty, not a supplement to traditional retail, but the default context for certain categories. A host with a loyal audience can move more inventory in a 2-hour stream than the physical store might sell in a month. Young consumers often say that they trust a live stream host more than a brand's own marketing. But this always-on environment does something complicated to consumer behavior. It lowers the friction to buy, and simultaneously, it floods consumers with choice and price comparisons and competing claims. The result is not more impulsive spending. It is, paradoxically, more informed and more demanding spending. When you can see exactly what something costs on 3 different platforms in just 30 seconds, you become a much harder buyer to satisfy on price. Digitalization has made the Chinese consumer more reachable and more scrutinizing at the same time. That is the environment that every brand, domestic or foreign, now has to operate in. Now, I want to connect all of these to the property sector, because that is where the tone of the entire consumer narrative shifts. Chinese property slump is now in its 5th year. Roughly 80 million homes sit unsold or vacant across the country. More than 60 major private developers have defaulted on offshore bonds or entered restructuring. One Chinese economist estimates that as many as 80% of developers and construction firms could ultimately exit the market as the sector permanently contracts. I covered this in depth in the property episode, so I won't repeat all of the details here. But I want to focus on one specific channel, what it has done to household balance sheets and therefore to household behavior. Residential property represents approximately 70% of assets for urban Chinese households. In other words, the apartment is not just where you live. It is your savings account, your pension, your store of value. For most urban families, property wealth was the foundation of financial confidence, the thing that made future spending feel safe. Macquarie estimates that roughly 85% of the price gains that underpin that wealth have evaporated since 2021. The mortgage is still there, the value is not. Rhodium Group tracks the behavioral consequence directly. Between 2019 and 2023, China's average propensity to consume, the share of income that households actually spend as opposed to save, fell by approximately 4 percentage points. The propensity to save rose by around 15 percentage points over the same period. In other words, households looked at their balance sheets, saw what had happened to their main asset, and pulled back. They started paying down mortgages and credit card debt. They shifted money into fixed deposits. They stopped upgrading. This is the mechanism that connects the property bust to the consumption problem that Beijing keeps trying to solve with vouchers, rebates, and consumption campaigns. Until household confidence in the value of their primary asset is restored, or until strong enough safety nets exist to replace it, the spending caution has a structural foundation. It is not irrational, it is a rational response to a genuine wealth shock. This brings us to 消费降级, consumption downgrade. And I want to be precise about what this actually means, because the term covers two very different phenomena. A 2024 Hakuhodo survey reports that approximately 8% of Chinese consumers say they are choosing cheaper products or services than before. The index of willingness to consume is down 9.1 points compared with 2019. Luxury spending is estimated to have fallen around 20% in 2024 alone. Those are large numbers, but the CEIBS commentary that analyzes this trend makes a useful distinction, which I think is analytically important. There is active downgrading, and there is the passive downgrading. Active downgrading is a choice. Consumers who decide, on purpose, that they are done paying premium prices for things that don't justify them. They are not distressed. They are re-evaluating. They have concluded that expensive does not mean better, and that the simpler version or the domestic brand is genuinely good enough. This is a value shift as much as an economic one. Passive downgrading is different. It is downgrading under pressure. Households that have lost property wealth, face income uncertainty, or carry mortgage debt they can no longer service comfortably. They are not choosing simplicity. They are managing constraint. Both are real. Both show up in the same survey data, but they have different implications. Active downgraders can be won back with genuine value propositions, quality at honest prices. Passive downgraders are waiting for the underlying financial pressure to ease. Rhodium's assessment is direct. They find little sign that consumption will snap back to pre-pandemic growth rates, and describe what they are seeing as much more evidence for a structural downward shift, driven by income distribution issues, weak social transfers, and lost property wealth. McKinsey uses the phrase 新常态, the new normal, for a mode of spending shaped by caution rather than exuberance. Put plainly, trading down is no longer a temporary adjustment. For a significant share of Chinese households, it is becoming the default mode. At the same time, and this is the tension that makes the current movement genuinely interesting, something else is happening in parallel. Guochao, usually translated as China chic or national tide, the rise of domestic Chinese brands as objects of genuine preference, not just cheaper alternatives, but actively chosen expressions of identity. Renmin Forum describes the shift as people are moving away from dependence on foreign brands and toward local ones. In some categories, domestic brands have already overtaken international competitors in consumer preference, not just on price, on desirability. A joint report from Xinhua and Dewu puts specific numbers on this. For those who are not familiar with Dewu, it is a youth-focused platform that functions as part sneaker marketplace, part cultural barometer. Compared with 10 years ago, interest in Guochao has grown more than fivefold. 78.5% of surveyed consumers say they prefer Chinese brands. Post-90s and the post-2000 consumers, those born after 1990 and 2000, account for approximately 74% of Guochao consumption on the platform. A Peking University paper frames Guochao as 消费文化潮, a consumption culture wave led by local culture, brands, and products, and tied to what it called consumption practices that carry cultural and political identity. In other words, buying Chinese isn't just an economic decision. For many younger consumers, it is a statement. But here is where Guochao intersects with consumption downgrade, in a way that's easy to miss. The most successful Guochao brands are not just culturally resonant. They are also rigorously value for money. Securities research on national brands uses phrases 高质量, 高性价比, high quality plus high value, as the defining characteristic of breakout domestic brands. They have to offer what younger consumers want at accessible prices, because the audience they're competing for is simultaneously identity-driven and price-scrutinizing. The demand is there. The filter it passes through has simply become much stricter. So where does all of this leave the idea of the Chinese consumer, singular? It dissolves it. A 2026 overview from Chou Zan captures the divergence cleanly. In 2025, rural incomes grew at around 10.6%, more than double the roughly 4.5% growth for urban residents. Rural retail sales are accelerating, supported by revitalization policies and the expansion of e-commerce into lower-tier cities and townships. Meanwhile, urban middle-class households facing property depreciation and uncertain job prospects have become more cautious. Gen Z in lower-tier cities looks, in many surveys, more optimistic than their counterparts in Shanghai or Beijing. They carry less mortgage debt. They often have the family financial support as a buffer. They are active participants in Guochao and the new domestic brand ecosystems. They spend on experiences, health, and digital content. Older urban cohorts, by contrast, are managing a more difficult set of variables. More debt, more exposure to property wealth loss, more responsibility for children's education and aging parents simultaneously. Their spending posture is defensive, not expansive. What this means in practice is that China consumption is not a single curve. It is several curves running simultaneously, at different speeds in different directions. A deleveraging, risk-averse urban middle class, a more optimistic but value-driven younger cohort in lower-tier cities, an aging demographic with high precautionary savings and shrinking appetite for discretionary spending, and a rural population with rising incomes but a very different product and brand preference set. Aggregate consumption data hides all of this. On the ground, it shapes what it sells, at what price and where. Let me close with the questions that will define this story over the coming years. Not predictions, but the markers worth watching. First, is this behavioral shift structural or cyclical? The evidence, as I've laid it out, leans structural. The property wealth shock is not going to reverse quickly. Savings rates have been rising for years, not months. The trade-down behavior predates the most recent economic softness. If Beijing wants to move the needle on consumption, it likely requires not just stimulus vouchers, but genuine safety net expansion. Stronger pensions, broader healthcare coverage, real protection against downside income risk. Without that, precautionary saving has a rational foundation that won't be argued away. Second, which segments are actually growing, and what do they want? The answer is not uniform. Rural consumers with rising incomes, younger cohorts in lower-tier cities, and digitally native Gen Z consumers who blend identity and value. These are the parts of the market with genuine forward momentum. But they want something specific: domestic brands, strong quality-to-price ratios, cultural relevance, and a digital-first discovery. The old playbook, aspirational foreign brand, premium positioning, Tier 1 city flagship store, is not where the growth is. Third, does Guochao have staying power, or is it a wave? The fivefold increase in interest over a decade, the preference data from youth platforms, and the cost advantages of domestic brands in a value-driven market all point towards durability rather than trend. But staying power requires that domestic brands continue to earn it, on quality, on relevance, and on the relentless value for money standard that Chinese consumers now apply to everything. The open question that hangs over all of these is whether future income growth and stronger social safety nets create the conditions for a new phase of confident spending, or whether high savings, cautious households, and the shadow of the property decade define the consumption story for the next decade. That is not a question that resolves quickly, but it is the question that determines what the world's largest consumer market actually looks like when it grows up. This has been the China Memo. Thank you for listening. Before I go, nothing in this episode constitutes investment advice, a trade recommendation, or a solicitation to buy or sell any security or product. The China Memo is produced for informational and educational purposes only. All views are analytical observations based on publicly available sources. For any financial or business decisions, seek independent qualified advice.